Everyone, and welcome to this explainer. Look, think of me today as your trusted financial advisor. We're going to sit down, look at the facts, and safely navigate one of the absolute most popular and frankly most misunderstood tax planning strategies out there. We're talking about claiming House Rent Allowance, or HRA, by paying rent to your parents. Salaried employees attempt this every single year, but doing it wrong? Well, that can trigger a really painful income tax notice. So today we are going completely by the book to protect you and your money.
Before we set up your personalized tax plan, here's a quick look at the blueprint we'll be covering today. First, the HRA shortcut myth, then the data-driven tax trap, your 5-step legal checklist, the problem with cash, and finally, aligning your tax records.
All right, let's jump right in. Section 1, the HRA shortcut myth, separating fact from social media fiction.
We really need to start by separating actual tax facts from social media fiction. Because acting on hearsay, that is exactly where serious legal problems begin for cautious taxpayers. I am almost positive you've heard this advice from a friend, a coworker, or just some random internet post. Hey, just show rent paid to your parents and save tax. Or maybe, I live with my parents anyway, I'll simply claim HRA and save some money. It sounds incredibly easy, right? But as an advisor, I literally have to warn you. This casual attitude is a massive trap. Half knowledge in tax planning can be incredibly expensive.
So, let's address the most fundamental question you might be wondering about right now. Can you actually, legally, claim HRA while living in your parents' house? Is that honestly allowed under the Income Tax Act?
Well, the answer is a resounding yes, absolutely. The Income Tax Act does not prohibit it. If your parents own the house and you genuinely pay rent to them, you can for sure claim the HRA deduction. But, and this is absolutely crucial, the key word here is genuine. The rent's got to be real, the payment's got to be real, and the documentation must be real. It can't just be some artificial arrangement or a last-minute year-end trick just to save a few bucks.
Which brings us to Section 2, the data-driven tax trap, why last-minute receipts won't cut it anymore.
Okay, let's really dive into this, because the old days of just quietly writing up a few fake rent receipts at the end of the financial year in March, those days are completely over. That shortcut is a massive risk today. The Income Tax Department has become incredibly data-driven. They're actively comparing your bank transactions, your PAN information, and your annual information statement, which, if you didn't know, is essentially a master digital ledger of all your financial transactions. Add in your income tax return filings, and the picture becomes crystal clear to them. If you suddenly generate rent receipts in March without any actual traceable rent payments throughout the year, serious questions are going to arise. The system is literally designed to catch these artificial setups.
Moving right along to Section 3, your 5-step legal checklist, the professional way to structure your HRA claim.
So how do we actually protect you? Well, here is your ironclad, step-by-step checklist to structure your HRA claims so you can just sleep soundly at night. And please, do not skip a single one of these. Step 1. You must execute a proper written rent agreement with your parents. Treat them exactly like you would any other landlord. Step 2. You need to transfer that rent every single month through a traceable mode. That means a bank transfer, UPI, or NEFT. No sudden lump sums at the end of the year. Step 3. Maintain proper, signed rent receipts for those payments. Step 4. If your rent amount requires it by law, obtain your landlord's, meaning your parents', PAN card details. And Step 5, which is honestly the most vital piece of the puzzle, your parents must disclose this rental income in their own income tax return.
I want to emphasize this because Step 5 is where almost everyone makes their biggest mistake, and it is absolutely non-negotiable. If you claim the HRA deduction to reduce your taxable income, the tax department sees it as your parents legally receiving that money as income. Therefore, they must report the corresponding rental income in their ITR. Skipping this step, that's the primary trigger for department scrutiny.
All right, Section 4, the problem with cash, why traceable payments are your best defense. As an advisor, clients ask me about this specific pitfall literally all the time when they're setting up their payment structures. The question is simply, hey, can I just pay my parents in cash and still claim HRA?
My answer to that is a definitive professional warning against cash. Look, cash payments leave absolutely no audit trail. If the tax department starts asking questions later, cash transactions are extremely difficult to prove. I highly advise against it.
On the flip side, making a monthly NEFT or UPI transfer, that creates a clear, permanent audit trail. It acts as undeniable evidence that the transaction was totally real. For a cautious taxpayer looking for real protection, bank transfers are strongly recommended. Always maintain your evidence.
Finally, let's look at Section 5, aligning your tax records, preventing mismatches and protecting against notices.
A data mismatch has severe consequences. Think about it. If you tell the government, hey, I paid rent, give me a tax deduction, but your parents' tax return says, we didn't receive any rental income, the system is going to flag that immediately. It's a huge red flag. The department may very well treat this mismatch not as some innocent error, but as a deliberate attempt to evade taxes. It literally transforms that famous internet shortcut we talked about into a very costly mistake.
And that really brings us to the core philosophy of smart financial management. Tax planning is legal. Tax evasion is not. Following the law, actually creating the agreements, making the bank transfers, and reporting the income, that's what allows you to enjoy the financial benefits of HRA without the anxiety of a looming audit. You know, people spend way too much time trying to find sneaky loopholes when simply understanding and following the law is a much better, significantly safer strategy. So let me leave you with this final thought. Are you ready to replace internet hearsay with an ironclad, legally compliant tax strategy? By following the 5-step blueprint we outlined today, you can confidently claim your legal deductions while maintaining the ultimate protection against tax notices, which, at the end of the day, is just strict compliance. Review your arrangements, get your documentation perfectly in order, and make sure those records align. Thank you so much for joining me for this explainer. I really hope this brings you the clarity and confidence you need in your tax planning.